You know, every great company out there, whether it's the corner coffee shop or some massive tech giant, it all started with just an idea. But what's the magic that turns an idea into a real, valuable business? Well, it's not just about passion. It's about having a framework for making smart decisions with money. And in the next few minutes, we're going to give you that exact framework. Think of it as a founder's guide to corporate finance.
So you've got it, the vision, you've got the drive, but turning that spark into a business that actually lasts, that means you've got to answer some pretty tough questions about money. And this isn't just about spreadsheets and accounting, it's about making big strategic choices that are going to define your company's entire future. And look, let's forget the term corporate finance for a second. I know it sounds intimidating, but at its heart, it's just a way of thinking. It really all boils down to three fundamental questions that every single founder has to answer right from day one.
These three decisions, they're the absolute bedrock of your whole business. First up, capital budgeting. What big, long-term stuff do you need to buy? We're talking about your buildings, your machinery, your key technology. Second, capital structure. Okay, how are you going to pay for all that stuff? Are you going to use your own money, get a loan, or are you going to give up a piece of the pie to bring in partners or investors? It's a huge trade-off. And finally, working capital. This is all about the day-to-day cash. How do you collect money from customers and pay your suppliers on time? This is the financial lifeblood that keeps the lights on. So those first three decisions are about your stuff and your cash. This one's about you. How are you going to legally structure this thing to protect yourself and set it up for real growth? Believe me, this choice impacts everything, from your personal risk to your ability to raise serious money later on.
Let's just compare the two most common paths here. On one hand, you could be a sole proprietor. Simple, right? You and the business are legally the same thing. But, and this is a huge but, you have unlimited liability. If the business goes under, your personal assets, your house, your car, they're all on the line. A corporation, on the other hand, creates a legal shield. It's a completely separate person in the eyes of the law. That not only protects you, but it makes it a heck of a lot easier to get investors on board.
So why do pretty much all companies with big dreams become corporations? Well, it really comes down to these major advantages. Limited liability means investors can take a chance on you without risking everything they own. And unlimited life means the company can keep going long after the founders are gone. But the real game changer? The ability to transfer ownership through stock. This is, without a doubt, the most powerful tool ever invented for raising huge amounts of cash.
Of course, there's no such thing as a free lunch. The biggest downside to being a corporation is something called double taxation. Here's how it works. First, the corporation pays taxes on its profits. Then, when it pays out those profits to you, the owner, as dividends, you have to pay personal income tax on that same money again. It's basically the price you pay for all that protection and potential for growth.
All right, so you've picked the corporate structure. You're ready to bring in investors. Now everybody needs a single, clear mission to rally around. What is the one goal that everyone, from the CEO down to the smallest shareholder, is actually working towards?
Now, a lot of people would just say to make a profit, right? Or maybe maximize sales. But those goals can actually be pretty misleading. I mean, you could maximize your profit this year by, say, canceling all your research and development, but that would kill the company in the long run. The true financial goal is way more specific and powerful.
This is the North Star. The goal of financial management is to maximize the current value per share of the company's stock. Now, why is this so powerful? Because a share price isn't just some random number. It's a real-time report card that reflects everything the company is doing. Its long-term strategy, its daily execution, all of it.
And hey, don't just take my word for it. This is the principle that drives real-world leaders. Roberto Goizueta, the legendary CEO who transformed Coca-Cola, he put it pretty bluntly. We work for our share owners. This intense focus on creating value for the owners is really the engine that powers growth and innovation across the entire economy. But this leads to a really interesting and very human problem. See, once a company gets big enough, the owners, the stockholders, are not the same people running the business day to day. And that little separation, well, it creates a natural conflict. It's called the agency problem. Think of it like this. The stockholders are the principals. They are the owners. They hire management, the agents, to run the company for them. But what happens if the agents start making decisions that are better for their own careers or wallets than for the owners? That's the agency problem in a nutshell.
And this conflict has real costs. You've got the direct costs, the obvious stuff, like management buying a fancy corporate jet that doesn't really help shareholders. But the indirect costs, oh, those are often way bigger. This is the cost of a missed opportunity. Imagine a manager who's too scared to take on a risky project that could be a total game changer, just because they're more worried about protecting their own job than creating value for the owners. That's a huge hidden cost.
Okay, so we've got our corporation, we've got a goal, and we have this potential conflict we need to manage. But where does the actual fuel for growth, the money, come from in the first place? Let's zoom out and see how our company plugs into the big, wide world of finance.
So money flows into the company through two kinds of markets. First, you have the primary market. This is when the company creates and sells brand new stock to raise cash. It's a direct injection of capital. Then you have the secondary market. Think of the New York Stock Exchange. This is where investors just trade those existing shares among themselves. The company doesn't get a penny from these sales. So why does it matter? Because without a healthy secondary market, where investors know they can easily sell their shares later, nobody would ever buy them in the primary market to begin with. It provides the all-important ingredient of liquidity.
And this slide right here puts it all together. It's the entire life cycle of cash. So, step 1, the firm sells securities to investors. Step 2, those investors give the firm cash. 3, the firm uses that cash to invest in its business, its people, its machines. 4, those operations generate even more cash. And finally, step 5, that new cash either gets reinvested to keep growing or it gets returned to the investors who funded the whole thing. And the cycle starts all over again.
All right, we have covered a ton of ground, from a tiny idea all the way to the global flow of capital. So let's distill all of this down into a simple, powerful toolkit that any founder can start using today.
Here it is, your core finance checklist. First, always be juggling those 3 key decisions: budgeting, structure, and working capital. Second, pick a legal structure that's actually built for growth and protects you. Third, make maximizing long-term shareholder value your ultimate North Star. Fourth, know that the owner-manager conflict is real and actively manage it. And finally, see the financial markets for what they are, the engine that can power your entire vision.
And this brings us to one last and really critical question. The framework we've just talked about, this focus on maximizing shareholder value, has built some of the most incredible companies in the world. But today, that conversation is shifting. How do you ethically balance your duty to your owners with your responsibilities to your employees, your customers, and to society as a whole? Answering that question might just be the single biggest challenge for the next generation of founders. Thanks for joining us.